Hello everyone. It is Sunday, May 21st, 2023, 12 noon Chicago time. I'm John Kosar, and this is your monthly investment compass, charting the course of the markets. There's a lot to cover here as the S&P 500 has been drifting sideways since first week of December. It indicates indecision. The market doesn't know what to do here. You could see it in most of our models. You could see it certainly in our CEF model as the money moving around the S&P 500 is kind of vacillating every 2 weeks between risk-on sectors like technology and communication services, which is the case right now, and then switching right back to more defensive places like utilities and consumer staples. Sometimes you'll have, actually there's been a few occasions where the two top sectors, according to CEF, according to asset flows in, were at opposite ends of the spectrum. You might have a technology and a consumer staples both at the same time. So this is a real good time for this. We're crowding 4,200 now in the S&P 500, which is the top of that 6-month indecision period that is bordered by 3,800 on the downside. Let's go through the executive summary first. Basically, I'll be giving you the answers, giving you the conclusions, and then we will look at charts, data series, models to learn how we've come up with these conclusions. S&P 500, as I mentioned, is currently testing 4,200, upper boundary of a 6-month period of sideways investor indecision. A sustained rise above 4,200 amid several important items, low volatility, an increase in volume, and a continuation of recent asset expansion that we've seen in some important ETFs like SPDRs and QQQ is necessary to indicate that we have an upside breakout. Bigger picture, there are some chart patterns in several major U.S. indexes that suggest the potential for another 13 to 17% higher from where we are right now. But let's not get too far ahead of ourselves. We need that breakout above 4,200 with those individual ingredients that I just mentioned, like volume and asset flows and volatility. The spoiler in all of this is that there are a handful of really influential tech stocks that are all testing formidable overhead resistance levels. We're going to take a look at them. They're in Apple, they're in Microsoft, they're in Alphabet, and they're also in Meta, formerly Facebook. That could be the fly in the ointment. If these big stocks stop at these levels and start to turn lower, that can push the S&P right back into the middle of that sideways pattern here. So it still hasn't cleared up, but we have some really important things to watch here. And I think if we know what to watch right now, that's really going to help us navigate this. In terms of size, large cap stocks remain in a March 10th trend of strategic relative outperformance versus the S&P 500, have outperformed by 1% since then. Growth stocks remain in their trend of their March 6th trend of strategic relative outperformance. To answer the question of style, either growth or value, it's towards growth. And SPY-G, which is the ETF that we are tracking for this particular comparison, SPY-G has outperformed the S&P by 3% since then, since March 6th. Domestic allocation, asset allocation. This is according to the CARP model. CARP stands for Cross Asset Relative Performance. Through May 19th, which is this past Friday, there are now 5 offensive risk-on relative relationships in CARP from just 3 offensive ones a few weeks ago. It's a slight market positive shift, and suggests to us that the market is starting to get a little bit more risk on, maybe starting to feel a little bit more comfortable about an eventual resolution to the upside of this S&P 500 4200 area. Global relative performance according to our US versus the world model. Again, through the end of last week, through May 19th, there are just 3 countries currently outperforming the US on both a tactical and strategic basis, down from 14 countries just 3 weeks ago. This appears to us like the US is coming back into favor again. It could be that the US is starting to crowd that 4200 area, and maybe there's some money moving around that's anticipating an upside breakout in the S&P, which would establish a new uptrend in the S&P 500, or it would reinforce the current short or the current major and minor uptrends in the S&P 500 as they're defined by their 200 and their 50-day moving averages. Sector selection, sector rotation, our SEAF model. SEAF stands for Sector ETF Asset Flows, currently favors the technology and communication services sectors. And finally, U.S. interest rates. The yield of the benchmark U.S. 10-year note is testing important yield support at 3.46%. That's the 52-week moving average in 10-year yields. We're going to take a look at that at the end of the presentation, while amid favorable tactical conditions for a potential test of 4%. So let's get started and look at some of the detail. Price and trend 1. Large cap tech and semis target a 13% to 17% advance. This is the SOX index here on the left. It's a daily chart that goes back to early part of 2022. What the chart is pointing out here is that this kind of long rounded bottom here is actually a chart pattern. It's called the inverse head and shoulders. It's a bullish chart pattern. We broke out of the pattern on January the 23rd, kind of came back and retested the breakout in the middle of March, and now SOX is moving towards its highest level that we've seen in about a year. That is positive as long as we stay up above 2791, which is the current location of the 200-day moving average. It targets a move to 3750. Here on the right is NDX. Weekly NDX is a NASDAQ 100. That's the large cap index. It's March 24th breakout from a similar pattern, a similar inverse head and shoulders pattern, targets a 13% rise to 15,600, which is up here. That will stay valid as long as we stay up above this 12,139 area down here, which is the 52-week moving average in the NDX. This is a weekly chart. Note that this pattern started from important support at the September 2020 low here at 10,678. You like to see these chart patterns originate from some visible support level, and that's what happened here. So again, this is larger picture. We still have to get up above 4,200 in the S&P 500 first, but these are some bigger picture ideas to think about. Here's price and trend number 2, RUT and NYSE testing long-term support levels, and this is an inflection point for the both of them. This is a Russell weekly, RUT weekly, going back to middle 2018, and what it shows is a major support level based on the August 2018 high and January 2020 highs of 1715 and 1742. Here you've got the 200-day moving average just above the market here at 1816. What I want to point out here, and I've been beating on this for about a year now, we've had 6 tests of this very visible, formidable support level over the past year, and the market's hanging on by its fingernails. I should say the index is. The doomsday scenario for me, or one of them, that's kind of our job here, is not to paint a sunny picture for you with blue skies, but rather to show you where the potential potholes are. And this is one of those. If the Russell were to break significantly through 1700, let's say banking issues arise, or a problem with the debt ceiling. This is the chart you want to be looking at. We start getting significantly under 1700. This opens the way for a much bigger move down here. There's really no support down here. And the Russell, which has been underperforming for some time, we'll take a look at that in just a few minutes, just a couple of slides ahead of us. The Russell generally is a leading indication of where the S&P 500 goes. So are the tech indexes, the NDX and the comp. But right now, a failure in Russell would be a red flag to me and an indication that there's some bigger picture, potentially systemic problem that is looming. We're not there yet. It's holding that support, but this is a chart to keep an eye on. You don't want to get run over in the case that we have a bearish reversal here. So that's enough said about the Russell. Here's the NYSE weekly, the NYSE. I look at the NYSE as kind of a cousin of the Dow 30 because these are typically better stocks. They're more high quality stocks than the NYSE. Look what's happened here. We've got, again, support here from Jan 2018 and Jan 2020. Those support levels are start at 14,183 and go down to 13,637. Tested those 3 times here since about a year ago, starting to turn higher. We don't have the kind of strength that we have in the NASDAQ indexes, but it's still managed to grind up here, up above its 52-week moving average. And again, there's more support here. So as we look at these charts, we're seeing that there's a lot of long-term support. That indicates that this is a major inflection point. This is a long-term inflection point for the stock market, which I believe where the next major trend, either up or down, is going to begin. Now here's the S&P 500. This is a much more near-term chart. This chart starts in Q4 of last year, starts in October of last year. And here's the parameters of the sideways pattern here. 4,200 up top. That's the February 2nd high and the May 1st high. We were testing it at the end of the session on Friday. Down underneath is 3,800. You can see it's very well defined. Sideways means investor indecision. And generally new trends spring out from these indecision areas. The real start of this indecision, I believe, was in the beginning of December when we made a couple of failed attempts to get up above the 200-day moving average. And then we've expanded the range from there, but it's been sideways really since the end of last year. A move above 4,200, a sustained move above 4,200 would be necessary to signal a bullish breakout. And again, we need some indications, like some secondary indicators, which we're going to look at momentarily, to support that breakout up above 4,200 should it happen. So now we've got, we've got some relative performance to look at here. On the left, this is the SOX index, Phillips Semiconductor Index daily, going back to the fourth quarter of last year. The key takeaway here is at the very end of last week, we're starting to see the SOX outperform SPY, the S&P 500 ETF, on a quarterly basis, 63-day basis. That's the strategic time period for us. Just the start of that trend, but again, that's a good sign. You typically want to see your faster horses outperforming, and that's technology and that's semis. So we're going to be watching this relative performance here over the next few weeks to see if it can continue in semiconductors. Here's the comp here on the right. This is daily, also going back to Q4 of last year. The comp is the NASDAQ Composite Index. It's the bigger of the two NASDAQs. The NASDAQ 100 is the smaller, larger index. It's a broader index. The comp is what we call it here. Note that it's been outperforming SPY here on a quarterly 63-day basis since Jan 20. And it's been outperforming on an annual basis, on a 252-day basis, which is a business year, since March the 15th. And look, we came right down and tested both of those trends on April the 25th. And now we're eking out new relative performance highs. This is very bullish. And this really makes it important for those bigger tech stocks, which we're going to look at in just a minute, to be able to perform from here. But these two charts are positive for the market. Relative performance 2. Offensive small cap, defensive blue chips are underperforming. Here's the small cap index, which has been really weak. It's been underperforming the S&P 500 on a quarterly 63-day basis since March the 9th. It collapsed to fresh relative underperformance lows here on March the 22nd. And outright, it's been below its 200-day moving average since March 10th to indicate a major downtrend. Again, that's the one we're concerned about. The chart that we looked at of RUT sitting on that big support level around 1700. So this is one of those levels that you want to keep a kind of a sideways eye on throughout the week and make sure you know what it's doing, because that's one that could turn the tables on things should things get weaker from here. Here's the Dow 30 here. Dow Jones Industrial Average, DJIA daily, going back to December of last year. Here's its relative performance versus the S&P 500 underneath here. It's been underperforming the S&P 500 since January the 17th. That's important because this is a defensive index. This index typically outperforms when the broad market's going down, underperforms when it's going up. When people are bullish, they're looking to increase the beta on their ideas. So they're tending to move out of the Dow 30 and moving into other places. So even though this is relative underperformance since the middle of January, this is actually bull market behavior. Now let's look at those individual key stocks that are really important through the rest of the quarter. This is Apple, obviously number one in market cap. Look where it is. At the end of last week, it's testing the lower boundary of this band of very formidable overhead resistance from 176.15 all the way up to 182.94. There's three levels here. The August, March, and Jan lows of last year. Big walls of resistance like this are not typically broken sustainably without some kind of a correction first. So this chart, it worries me with the S&P trading 4,200. You got to be careful not to bite on that first move above 4,200 by the S&P 500 unless you know what Apple's doing. Now here's Microsoft here, right next to it, another large cap tech stock, number two according to market cap, and it is trying to break its March 2022 high of 315.93. Closed a little bit above it on Friday. Not enough to make me a believer that we have broken out here. So Microsoft is another one that you want to keep an eye on over the next week or two, because these two together are 15% of the market according to market cap. They're monstrous in terms of their sway over the market. So watch these two closely. Here's key stocks number two. Alphabet here, GOOG on the left, is number three according to market cap. It is testing its major resistance at 124.64 to 123.26. That represents the January 2022 benchmark low and the retest of that low on August 15th of last year. Another huge level, number three in terms of market cap. On the right is Meta, Facebook. Number six according to market cap, also testing a big resistance level at 244.61, which is his January 2021 benchmark low. I'm circling it. So again, keep an eye out on these four stocks. Ton of market cap here, a ton of influence. These stocks tend to be, they tend to lead the broad market up and down. They're the tip of the spear. So what happens to these stocks, in my mind, between now and the end of the quarter is where we're going to be at in the S&P 500. Not a lot of people talking about these, but the fact that they are all testing these major resistance levels at the same time is a very important phenomenon to be aware of. Here's our CPM model. Those of you that are new, CPM is our wealth preservation model. I built this model somewhere in the neighborhood, the first version of this, somewhere in the neighborhood of 15 years ago. What the CPM does well is it allows you to stay close to the S&P 500, trading the model with less than half the risk. And I'll show you what I mean by that. Well, CPM, first of all, it's risk off as of May the 3rd. You see all of this oscillation here. This is very abnormal for the CPM to be whipping back and forth between up and down and up and down. It doesn't happen very often at all throughout the 11, 12-year history of this thing that we have backtested that we're going to get to in just a moment. That just shows you the market is really right there at an inflection point, up or down. You see normally you have these big broad moves. Here we're risk off on April 12th of last year, back to risk on at the end of May. Risk off at the end of August of last year. We go back to risk on October the 25th. There's usually some back and forth. There is not very much back and forth right now. And again, there's a lot of energy that is building up here, which I think is going to lead into the next trend. Here's why the CPM is important. Over the past 12 years, from 2011 through 2022, on average, the S&P has underperformed the S&P by 2% a year, 8.8% average performance plus 8.8% compared to the S&P 10.8%. So why is that good, you might ask? It's because it was able to do that with beta of 0.44. Beta is one of many ways to measure market risk. 0.44 versus 1.0 for the S&P because it's the benchmark. Standard deviation risk only 9% on CPM versus 14.4% for the S&P, quite a bit less. Maximum drawdown only 15% in CPM versus 34% for the S&P 500. So again, for older, wealthier, more risk-averse investors, we have a lot of those, both people that are managing money for those people and individuals themselves. This, to us, was an important tool to play the game. You don't give up a lot of performance here for a lot less risk. Now here's our Asbury 6. A lot of people ask, what's the difference between CPM and Asbury 6? CPM is a actionable model. The Asbury 6 for me is an indicator. It shows me the internal health of the market on a day-by-day basis. I use the metaphor when you go for your annual doctor's checkup. The first thing the doctor does is he puts you up on the bench and he does those battery of 6 tests. Takes your blood pressure, he checks your pulse, he listens to your heart and lungs, he checks your reflexes. He wants to determine what your baseline health is, which may be different than how he thought you looked when you came in the door with your hair combed and a nice shirt on. That's what this does for the market. And right now, it's currently positive. So we've got the A6 is positive, but look at all this chop here. A6 is positive, CPM is negative. It shows there's a lot of angst at 4,200. Here is the actual through the end of last week. This is what the A6 looks like. 4 of the 6 constituent metrics are positive and 2 are negative. Let's look at them individually. Momentum via the monthly rate of change in the S&P 500 is positive as of May the 17th. That's midway through last week. We could be making a little rounded bottom here in this indicator. It's too early to tell. The only thing that is apparent to me is it's chopping around on both sides of the zero line, which means inflection, which means this is where the next trend is likely to begin. It isn't clear yet, but right now it's positive. The Asbury 6 also includes relative performance of stocks versus high yield bonds. For that, we look at SPY, the ETF, versus JNK, which is another ETF. When stocks prices are outperforming high yield bond prices, as has been on a 21-day basis, which is our tactical time period. Strategic 63 or one business quarter. Tactical is 21 days or one business month. Note that this is positive since May the 4th, and so this is positive, a positive input for the A6. Note that between Jan 20 and Feb 21, it gave us all of this. So this is currently positive. ETF asset flows in the spider. which tracks the S&P 500. Note, it's above its 21-day moving average since May the 5th. It's positive. It was previously positive from March 20th to May 1st, which gave us most of this rally here. So this is another positive A6 constituent. High yield corporate bond spreads. We use the Bank of America Merrill Lynch U.S. High Yield Master 2 option adjusted spread. That's quite a mouthful. You could find this on the Fed's website on the internet. Just edged into a new trend of 21-day narrowing or monthly narrowing on Friday. That's a positive for equities. Again, it's only been there for 1 day. But note the sideways movement here. The market is just not sure of what to do here, and you can even see that in high-yield corporate bond spreads. So again, all this sideways is going to eventually manifest itself in a new trend, but we have to understand the environment we're in right now, and that's one of uncertainty. But this particular one is currently positive heading into next week because a narrowing spread indicates tactical bond market lack of fear is the best way to say it. It's characteristic of tactical U.S. stock market advances. Let's go on to volume. For volume for the A6, we use on balance volume, which is a form of cumulative volume. We're going to look at another one here in just a moment. This is the one we use for the A6 on balance volume versus the S&P 500. And you can see it's effectively been negative. It's been underneath its 21-day moving average, which is negative for the market. You want to see volume increasing when the market's going up. It indicates urgency. So here we've got a rally here in the S&P 500, but really sloppy volume. A lack of urgency to buy is characteristic of tactical broad market decline. So this is one of the two negative ones right now. Finally, market breadth. For this, there's a lot of different ways to look at breadth in markets. For the Asbury 6, we look at the NYSE advanced decline line or the AD line, and you can see that that is effectively stayed negative since April the 25th with very little moves up above the 21-day moving average. Weakening market breadth is characteristic of tactical broad market declines. It isn't negative by a whole lot, but it's still negative. So this is number 2 of the 2 negatives that we currently have in the Asbury 6. These next 5 charts are other important indicators that aren't part of the Asbury 6, but I think they're really important now and you should pay attention to them. The VIX, volatility. Note how low it's been staying here, really since March the 24th. That gave us all of this rally. When the VIX is low, it indicates the market is not afraid of any problems coming up, and it usually that breath, that kind of sigh of relief, so to speak, is good for the market. It helps the market price go up. So the level to watch right now is a 21-day moving average, which in the VIX we use as kind of a trigger line. We start trading above 1733 in the VIX for more than a day or two. That indicates the market's getting nervous. It's going to push prices lower. But for right now, the VIX is near-term positive. Here's another one that we talked about earlier. Cumulative volume, on balance volume is one form of that. We also look at the NYSE Cumulative Volume Index. It's a really clean index that gives us very good signals. When this is expanding above its 21-day moving average, again, that's the tactical time period that we use at Asbury Research, like we had on January 4th through February 17th. And again on March 29th through April 24th, which is here, it gives us a strong market. Here's what's been happening lately. The market has been grinding. The S&P 500, I should say up top here, has been grinding to fresh highs, but look where this volume has been. It stayed underneath the 21-day moving average. This is what I was talking about in the very beginning of the presentation today. If the S&P gets above 4,200, I'm going to be looking at a few things. I'm going to be looking at the VIX. I want to see that VIX stay underneath 1733, which is where the 21-day moving average is right now. I want to see the NYSE CVI, as we call it, above the 21-day moving average and staying there, indicating urgency to buy. If we don't get that urgency to buy, we're not going to stay above 4,200 for very long. And that third thing we already looked at, we want to see asset flows in the SPY keep expanding on a monthly basis, staying above their 21-day moving average. Those three things are necessary on any moves above 4,200 in the S&P 500 in order for them to be sustainable. Here's some longer term metrics that I wanted to bring out here. We're drifting sideways, so a lot of these longer term metrics aren't giving us good signals. This is one that I think is worth looking at. This is a percentage of NYSE stocks trading 2 standard deviations above their 40-day moving average. So in other words, strong stocks. We were coming off of a low of 3% on April the 27th. That was a little short-term low here in the S&P 500 up top. Note these green verticals show every other time that we came off of a low of 3%, going back to the beginning of 2022. It's a pretty good bottom for the S&P 500. Even when we were in the midst of a downtrend, which we were last year, it picked off some very nice bottoms here. So this suggests to me that another sustainable bottom, meaningful bottom, may already be in place at the lows that we made at the end of April. So more of an intermediate term indicator that suggests a positive resolution to this rectangle in the S&P between 4,200 and 3,800. Strategic price momentum 1, intermediate term positive. This is a 13-week rate of change in the S&P. Note that since 2018, latter part of 2018, the 3 times that the 13-week RLC, rate of change, was underneath the zero line here were all the 3 most important moves down that we've had during that period. Now, the indicator's been a little sloppy. It hasn't been following the zero line in a really clean way, but the gist of this chart is since January the 13th, we moved out of this red period where it was below the 13-week moving average, and now we're back above it, and it looks like this little wiggle at the end, it looks like we're turning higher. This suggests that the 13-week moving average is building a base for its next move up. Now this is the same metric, strategic price momentum 2, but now we're looking at a 12-month rate of change, a little longer term time period. The takeaway here is back in December of last year, we got to 21% underneath the 12-month rate of change. That was a bottom. The last 3 times that we were at this extreme or even more extreme were February 2009, September 2001, and August of 1988. All big bottoms that lasted for years and years. So does that mean for sure that we got a bottom here? No, but it's something to look at. If we break out of 4,200 and we have some indicators backing us, if we can break to new highs in these big stocks like Apple and Meta and Microsoft, that suggests that these lows that we made could be the springboard for the next bull market in stocks. So again, there's a lot of cross currents going on outside. You've got some people are looking for recession. Some people expect interest rates to be through, interest rates hikes being over. There's a lot of money on the sidelines, and this is going to fuel the next bull market. We've got consternation over the banking issue. Are these banks that went under, are these one-offs, or is this a tip of an iceberg of a systemic banking crisis? And then, of course, we have Congress playing chicken with the debt ceiling again. So there's a lot of stuff that gives you the the backstory for all these charts. Now, just like the charts that we look at every month, just to see what they're doing, I like to kind of swing the club the same way all the time. I like to stick with the same indicators. Overbought, oversold. The S&P 500 is monthly overbought or tactically overbought right here. What does that mean? That means if we're either still in a sideways trend or we're still in the downtrend that we began at the beginning of 2022, this is where the downtrend should re-engage. I don't think that's where we are, but this indicator is telling you, kind of like if it walks like a duck and acts like a duck. The S&P, if the S&P 500 does an about face here, this indicator would suggest, hey, we're still either in a sideways or a down market. Here's the quarterly version of that metric, right in the middle. It really has no directional significance right now. So overbought, oversold is near-term negative, and the intermediate term is really neutral. Here's another way to look at market breadth. This is the percentage of NYSE stocks trading above their 40-day moving average, actually one of my favorite indicators. Note how this has done such a great job, even in a bear market last year, or in a major downtrend, I should say, last year, of picking off these important bottoms. March 13th, October of last year. This is June of last year. This is February of last year. The last one here was March the 23rd, and we're still heading higher. So this is tactically positive. It's near-term positive. The strategic version of this, which is the percentage of those NYSE stocks trading above their 200-day moving average, dead in the middle. It's neutral. It has no directional significance right now. So again, see a lot of one indicator says buy, one indicator says sell. The overbought, oversold is suggesting a negative outcome. This market breadth indicator, tactical basis, suggesting a positive outcome. That's what happens when the markets get stuck in neutral like we're at now. Investor sentiment, two different metrics here. This is, on the left, is a version of Jake Bernstein's DSI, or Daily Sentiment Index. You can see it's coming off of a March 16th low, headed higher. I would call that near-term positive, near-term bullish. Here on the right is the investors' intelligence data. There's different variations of that data. This is the bulls minus bears category. Asbury Research is actually one of their inputs for II. But note that we had this big buy signal here in this metric on October the 7th. We bottomed a week later on October 13th, and we're still rising in the indicator, and we haven't moved to most bullish opposite extremes. So this is positive, intermediate term positive for the II data. Seasonality right now is negative on an annual basis. You could see that May and June here, which are pink, they follow April, which is the second strongest month of the year, and May and June are the fifth and second seasonally weakest. So as we go into June, remember June's the second weakest month of the year seasonally. Then we have usually a little bump in July and even more weakness as we go into Labor Day. But right now seasonality is going to be negative for the next month. And you can see that here. This is a weekly seasonal pattern for the second quarter. So there's 13 bars here to represent the 13 weeks in the second quarter. So you can see May 1 to 19, which we just finished. Those were weak months, seasonal, or weeks seasonally. We have a little bump here at latter part of May, the beginning of June, and then the last 3 weeks of June are also really sloppy. So we're going into a period of seasonality that is negative. Seasonality for me is a tertiary indicator. I look at it as either as wind. Like if you're riding your bike down the street and there's wind in your face, it's not going to keep you from going in that direction. It may slow you down a little bit, but it's not in itself a strong directional bias. So that's why I wanted to point that out. Don't think just because seasonality is negative, the market has to go down. If the market goes up from here, seasonality may be a little bit of a headwind, but it's not going to be, in my opinion, strong enough to change direction of the market. Here's size and style next. Excuse me. Size is small, medium, or large. Large cap has been outperforming. SPLG has been outperforming, which is the S&P 500, has been outperforming SPTM, which is the S&P 1500, or the total of the S&P 4, 5, and 600. All three indexes, outperforming the 1500 by 1% since March the 10th. It looks like a great big move on the chart here, but in actuality, the difference between small, mid, and large within the 1500, you just don't get big, giant trends that have big percentage change. But this has been a steady outperformer here since March the 10th. Now, style. Style is growth or value. Growth, or SPY-G, has outperformed the S&P 500 by 3% since March the 6th, while SPY-G itself has made a major bullish trend change here on March the 28th. So large cap, growth, those two, size and style, have been the outperformers since March. This is our CARP model, Cross Asset Relative Performance is what CARP stands for. And you can see where the outperformance has been. Growth outperforming value. That is positive. That is risk on. Let's call it risk on. Technology outperforming the broad market, also risk on. Broad market, which is the S&P 500, outperforming blue chips, which is the Dow 30. That's also risk on. Here's large cap outperforming small. That tends to be a defensive play. But look at right here, high beta outperforming low volatility. High beta is a new trend. High beta, low volatility had been outperforming for much of this sideways action that we've had this year. Now you see high beta starting to outperform across all three categories: trading, tactical, and strategic. Again, a subtle but noticeable move that there's more risk on going on here just over the past 3 weeks, according to CARP. So here's growth that I talked about. Growth has outperformed value by 16% since January the 26th. So keeping in mind, while growth is going up, value is going down, so they're kind of inverse to each other, but growth has outperformed value by 16% since Jan 28th. It's a big move. Here's tech, which I talked about, tech outperforming the broad market. QQQ, which is the ETF for the NASDAQ 100, has outperformed SPY by 13% since January the 20th. In this sideways market, tech has really been keeping the market from rolling over and doing a header, frankly. So tech is so important here. Outperformed again, SPY by Jan 20th. And now we've got Microsoft and Apple and Meta and Google all testing these major overhead resistance levels. That's the theme right now. Watch those. If those four turn, this relationship is going to change. And if it changes, either something has to be running to the market's rescue to take over from what you see here on the right, and those are enormous shoes to fill, or the S&P is going to roll back into that range between 4,200 and 3,800. U.S. versus the world model. 3 weeks ago, there were 14 of these foreign countries out of the 24 that we track that were outperforming the S&P 500 on both a tactical and a strategic basis. Now you got 3, Chile, Japan, and Brazil. That suggests to me that the U.S. is becoming a little bit more attractive over these past 3 weeks as a relative outperformer versus the rest of the world. I view it as kind of a risk-on type of change that happened, where as the U.S. gets closer, as the S&P 500 gets closer to 4,200, you're getting people willing to shift their international bets now more in favor of the U.S. Here are two that our model caught early, but these trends are now being challenged. Here's Mexico. First showed up in the CARP model on September the 13th. It's outperformed SPY by 24% since then. But note that that trend is being tested as this relative performance line between EWW and SPY is testing its 63-day moving average. If it blows through it and stays there, that trend is over. And for those that have been participating in this trend, that would be your cue to take profits on this overweight. So I'm going to be watching this one really carefully here over the next week or so. Here's France, EWQ. First showed up in CARP on October the 10th, outperformed SPY by 23% since then. Now it's drifted slightly underneath its 63-day moving average, the relative performance line down here, that is. The more time it spends underneath there, the more likely that this trend is over. There was 5 or 6 Western European countries that were outperforming the S&P 500 a month ago. Now there's just like one left. So that big trend of relative outperformance by Western Europe appears to be winding down, starting to roll over. That's kind of what we're seeing here in France. I'm not convinced that France is over yet, but based on the fact that these other relative outperformance trends in other Western European countries have all slowly died off, this one might be dying off as well. So keep an eye on France next week. Our CEF model. Right now, the best scores are all risk on. Technology is tops in trading, tactical, and strategic, with the best score you can get is a 3. And here's communication services with a score of 6. It's 2 in the trading. It's ranked 2 in tactical and 2 in strategic. So right underneath technology, those are our 2 picks. And number 3, and the only other one that's still in our favorite category, which needs a score of 15 or less, is consumer discretionary, another risk-on sector. So the CEF model is starting to turn towards what I would call a much more normal behavior, where you're getting in that top spot in between 3 and 15, you're getting all risk-on names, rather than some risk-on and some risk-off, which has really been the case here for the past couple of months. It just indicates the money doesn't know where to go, and there are strong opinions on either side, some towards defensive stocks like staples, which we've seen, or utilities, and then some towards the offensive ones. This looks to me like a subtle shift towards a more offensive consensus in that money that's churning around the 11 sectors of the S&P 500. The 2 to avoid most heading into this week are energy and financials. They have the lowest scores. Here's the chart of what we just looked at. The 2 light green are the actual CEF signals, which have a little more criteria to pass, more hurdles to pass to become a quote-unquote CEF signal. And here's consumer discretionary coming in at number 3. Here's our energy and financials at the end, indicating those are avoids. Here's a CEF model through the end of last year. It underperformed in the first quarter of this year. I think it might be outperforming a little bit so far this quarter, but outperformed significantly in the first quarter. But prior to that, over the previous 10 quarters through the end of last year, it outperformed the S&P 8 out of 10 of those for a total outperformance of 36.4%. It's a good model. It only works when the money rattling around the S&P 500 knows where it wants to go, which is most of the time. This first quarter of last year was a very unusual quarter. I don't recall seeing one like this. I'm sure there was one. I've been doing this for 40 years. But that's why the CEF model had a tough quarters, because when the money doesn't know where to go, CEF is all it's doing is following the data, and the data is all over the place. This may be starting to change now. Here's some of the statistics that also go along with CEF. Beta on CEF a little less than the S&P at 0.91. Alpha way better at 9.6. Sharp ratio is very good at 1.01. Sortino ratio 2.12. Maximum drawdown a little bit less than the S&P during the 10-quarter period, 22.5 versus 25.4. And you can look at the annualized total return during this period has been quite a bit better, almost double. We gave some of that back in the first quarter, but overall this has been a solid model for us. This just shows CEF daily versus the S&P. CEF is in green. S&P 500 is in blue through the end of last year. Industry groups. We've got a few trades going on in the industry group space. These previous trades here during a really tough period since the beginning of the year with the market going sideways. These, I think there's 14 trades here. They've averaged a profit of about 2% a trade, and 63% of these trades made money. So pretty, I'm not thrilled with it. You always want to do better, but in a sideways market environment, it's very difficult to pick a lot of large winners here. And we've had a few here. We've had XAR for 9%. We've had gold miners, RING, for 9%. We had capital markets ETF. So we've managed to put together some pretty good ideas, I think, in a tough environment. So all this is available on the website, of course. Finally, let's look at interest rates. This is the yield of the 10-year monthly going back to 1900. The point of this chart is to put you in perspective, bigger picture. This is actually when I started in the business in October. I actually started in 1980, but that's where I began my career, with rates way up here. The average monthly yield since 1900 is 4.52%, and the S&P is it's about 90 basis points underneath that right now. So even though rates feel real high now because we've had a zero interest rate policy for a decade that we're just coming out of, it feels higher. Historically, it really is not. This chart on the right is the U.S. Treasuries weekly with their 52-week or 1-year moving average going back to 2004, so 10 years, 20 years here. Note that the yield of the 10-year is sitting right on top of its 52-week moving average at 3.46%. That's an inflection point. If we can stay above it, I think we move back for a retest of 4% to 426, which are these old highs that we made in Feb 2011 and in June of 2008. If we break down through it, now we're looking at these old highs from December 2013 and October of 2018 that start at 323 and go down to 3.04%. So tactically, what does it look like? That's what this next chart does. This is TNX, which mimics the yield of the 10-year note. It's a CBOE 10-year note index. How do we read this? Well, we've been in a sideways congestion period here really since March, bordered by 36.44 on the top side, which is basically a 3.64 yield. If you're looking at the yield, so you move the decimal place over one to the right, it's 3.644. Down in the bottom here, you've got the October 2018 benchmark high yields at 3.25%, or 32.50 really, according to TNX. And you can see we've tested it several times since then. We broke out of this range to the top side on Friday. That is positive, and it suggests we might be leaning towards a retest of that 4% area. The other last chart I want to show you today is tactical. TLT is the flip side of yields. TLT is the iShares 20-plus year Treasury ETF and moves inverse to the yields that you're seeing on the left side of your chart here. The on-balance volume in this ETF has been negative since April the 17th, which means it's negative for TLT. You can see TLT had 3 attempts trying to get through its 200-day moving average since the middle of March. Couldn't do it. It's rolling back underneath it now. As long as it stays underneath it, and as long as this unbalanced volume chart, it looks so weak, this is going to push these yields higher towards 4%. So if you ask me where are yields going right now, I think right now, if we stay above, let's back up 1 second, stay up above 346 in the yield at 10-year, I think we could revisit 4%. So a ton to go through. This is a really good time to do this report because there's so much going on. It's such an inflection point, and it's really important to know what to look at. And I think I've outlined that pretty well today. At least I hope I have. So there you have it. I'm just going to leave you with this. Part of what you're paying for having access to Asbury research is some one-on-one time with me. If you haven't taken advantage of that, we've just noticed over the years, we opened up the doors in 2005. Those who take advantage of these and schedule a time with me, we could either do a web conference or we could do phone if you're more comfortable with that. Let me show you how to use these tools. Those that I can teach how to use these tools, it's great for us because they never leave. We have customers that have been with us for a long, long time. Those are the customers who talk to us and let me help them. So if you haven't taken advantage of that already, I strongly advise you to contact us, send us an email, go to our website, say, I'd like to set up an appointment with John. and we'll send you our calendar. You can pick out a time that's going to be convenient for you, a time and a date, and I look forward to speaking with you then. We have Memorial Day coming up right around the corner. Hope everyone has a wonderful holiday. In the meantime, we will see you at the next one of these, which will be in just about a month.